Hello everyone, you might be wondering if I'm still warning of the Australian market being at the brink of collapse. Well, actually, I think you should still be a little bit worried about the Australian stock market. I haven't seen it in the last 20 or 30 minutes, but we've had another 112 cases in Sydney, and that number is likely to go up probably during the week. So we could be looking as long as a full month of lockdown is highly likely. But what if it sort of tips over into 2 months of lockdown for Sydney and the rest of Australia closing borders a little bit? That will be of particular economic impact. So in terms of the local market, I think there would be a lot of hedge fund managers out there now who are just beginning to scratch their heads. As if you were a responsible fund manager, you would be doing so based on just how long this will go on, what will the hospitalisation rate be, and all sorts of other factors that are involved with the current lockdown. In terms of the global stock market situation, we had that incredible 18-hour rally by the S&P 500 on Friday, just after I said things were looking very bearish and to be a little concerned. They must have heard me, the whole world. But it is a rally within the recent range. Or actually the S&P 500 made a new high, but the Dow Jones, the tech sector, they stayed within recent ranges. And the price action for the Dow Jones, the NASDAQ, and should the S&P 500 decide to retreat back into the range where the Dow Jones and the NASDAQ have remained, again, it doesn't take off the table my warning that things are a little bit odd here. We're kind of seeing what would usually be sort of panic selling to the downside near a major low, those last gapping lower sort of price actions. We're kind of seeing that to the upside. So we're seeing almost frightened price action to the upside at the moment in a lot of US stocks. It tends still to be a little bit focused and not the broad market. The broad market's very much sideways. Despite the headlines of indices making new highs and those sorts of things, and they might make new daily highs sometimes, but they're not making a new actual price new high. In terms of the global economic factors that maybe not everyone's looking at, and I think you should look at, first thing I'd say is that price action, it tends to be frightened price action to the upside. On any excuse at all. So a very scared market to the upside. So what I'm thinking is, and I've come up with a new acronym, is that the fear of missing out is greater than the fear of losing money. Maybe that's the definition of greed, I'm not sure. So FOLM, the fear of losing money, is losing out to the fear of missing out at the moment. See, I'm trying to be youthful here and plugged into to the latest current sort of language adaptations. I'm not sure how I'm doing though. But it is a valid point that people really aren't scared of losing money at the moment. They're just scared of missing out on further upside. And that itself is a bit of a worrying sign and could be an indication that markets are, as I've been suggesting, I'm not saying they absolutely are, but I have a strong feeling they are, and it's a scenario you need to think of in advance because in real time it could be very hard to keep up. So I think I'm doing a good thing for you in warning you that stock markets could still be making major tops here despite Friday's price action in the US. With the Australian stock market, it moved to the top of its range, and we know it can move quickly from the bottom of the range to the top of the range, top of the range to the bottom of the range at almost any time. So I think here near the top of the range and with the lockdown extension being likely for Sydney, that we're looking at stocks in Australia that are probably a little bit overvalued at the moment and a little bit too high. So I'm still cautious US stock market, bearish Australian stock market. And the other aspect of the Australian picture is the Australian dollar. Still very bearish, the Australian dollar. One of the economic principles I wanted to point out today, for Australia here, one of the economic principles I wanted to point out today was, I was talking last week and I wrote a little article. It wasn't the best piece I've ever written, but the concept was interesting. Divergent economics. And we saw that word start to be used on the weekend on Bloomberg News, by the way, talking about divergent economics. They were talking about different economies going in different directions, such as China reducing its core reserve requirement on Friday, which triggered a lot of that bullish equity price action around the world, and the US looking perhaps at tightening. Now the US Fed's going to be in a very difficult position because I think the economy is going to be slowing as inflation is taking off further. So what does a central bank do in those circumstances? There isn't a lot of historical precedent for that, so it'll be interesting to see how that pans out. But when I talk about divergent economics, I'm also talking about divergence between the middle wealthy class getting richer and richer, and for the first time since globalization started 25 years ago, I think the poor are actually getting marginalized a little bit. See, it was the case, everyone used to complain about the wealth gap widening. I never complained about that. I used to give speeches pointing out the wealth gap might be widening, the rich are getting richer, but the poor are also getting richer. So that was a stable situation, and it was good for everyone. You know, hundreds of millions of people came out of poverty during the last 25 years due to globalization, and global poverty rates crashed, which was a good crash to have. So my point though now is that post-COVID, we're seeing this kind of marginalization of a greater number, a greater proportion of many workforces around the world. And that could be semi-permanent or it could be permanent, but we're definitely seeing a divergent approach to economies. And it also helps to explain how in the US, which is only struggling to get back to where its economy was before, even with all these accelerated growth periods, and still has extremely high unemployment, that the equity market can be ignoring all that and just going through the roof. It's because there's a divergence between Main Street and Wall Street, or it's also a divergence between working class people who've lost their jobs, around 7 million of them who still haven't got them back, as well as the million or so who were unemployed before the crisis started. So those people are marginalized and the stock market's going through the roof. So I'm seeing divergent economics in terms of different countries and different positions, but also within every country, that kind of growing wealth gap that will now be a problem going forward. So that's something governments are going to have to pay a lot of attention to. The other thing, of course, that's the big change, and I just referred to, is China. You know, one of the reasons I was invited to speak at APEC in Russia in 2012 was because I was already talking and writing essays and giving speeches about how the world would have, and I've been doing it for several years before 2012, the world would have three equal superpowers: China, Europe, and the US, militarily, economically, and diplomatically. And you're going to have these sort of three spheres of influence. Now, the global equity market reaction to China adjusting its reserve ratio requirements on Friday really confirms that we're in a new age. What was very humorous was to see some publications, financial publications, still talking about or having a debate about whether China is an emerging economy or not. It hasn't been an emerging economy for about a decade. In fact, China was the big C that saved the little c in the GFC, which is China saved capitalism. And China capitalism, because we have to understand how the world works, right? And there is a political system and there is an economic system. And in China, China's economic system is very much capitalist. Its political system is not the sort of democracy we in the West are used to, but it is a one-party democracy. There are voices heard within the political system, but it's very dissimilar to what we have in the West or are used to. But in terms of economics, it's quite arguable that China is more capitalist than the United States, or particularly Europe at the moment, maybe even Australia, because we have so much government intervention and regulation and everything. Laissez-faire economics, going back to its textbook or original thought concept, is harder and harder to find in the old first world, that is the United States and Europe. The new first world, and has been for over a decade, is China, Asia. Why other economists and financial media organizations haven't sort of caught on to this yet is beggars belief, really. So do think of that equality between those three equal spheres around the world, and do keep an eye on equity markets looking a little bit soft here. The Australian dollar, I'm still very bearish towards 70 cents. risk 68.50, big numbers, I know. I made this call at 77.45, so it's kind of coming true, but still has a fair way to go. One thing to watch is Aussie gold. The gold price in Australian dollar terms has stayed very firm and looks very good, and that could be good for Australian gold miners. The other thing is Bitcoin. I've been saying for a long time, I wrote an article several years ago called Bit Zero, that Bitcoin would go to, this is when it was first got up to 5,000, that it would go to 20,000 US dollars and a lot higher perhaps, but then it would come back and perhaps go to zero. So I'm not sure the zero is going to actually happen, but I think we all need to be aware that that sort of rally and rolling over in a long-term sense is well in play for Bitcoin. And whilst it might be volatile and sideways and have big up days occasionally, I think the trend at the moment is still very much leaning to the downside for Bitcoin. Oil, I still think it's a major top, despite the strong rally on Friday. I'd be a seller of rallies in oil. And in terms of gold itself, vis-a-vis the Aussie dollar, is going to be going a lot higher, especially if I'm right about a weaker Aussie. But gold US, it does look just sideways consolidation, but with an upward bias. So that could get interesting as well. Overall, I'm still a little bullish the US dollar. Thanks very much for listening in today. Clifford Bennett, Chief Economist, ACY Securities.